you had one lever to pull while you were working. I want this income. I'll take it. I'll deal with the taxes. You flip the switch into retirement, and it's like we just put 5 or 6 levers on your dashboard, and we can kind of pull this one until we fill up the 10 and 12% tax brackets. And then maybe you decide, I'm done with that. I'm going to stop before I hit 22. And now I'm going to pull from my after-tax brokerage account, paying 15% capital gains on the growth of what we sell. And then you could say, oh, I'm about to hit that investment surtax. I'm going to shut that one off. I'm going to pull from my Roth for a little while. And you can really control the tax bracket so well if you are aware of where those lines are.
All right, we are lucky to have Zacc Call back with us. And Zacc, we are just off of the tax filing deadline for 2024 taxes here in 2025. So we're past April now. And I wanted to talk to you a little bit about some tax strategies that people can use and where to find them, because there's so much out there around. You need to take advantage of this tax strategy and that tax strategy, and it can kind of get a little bit overwhelming. So maybe you can walk us through a more simple way to understand how these work and who it maybe applies to.
Right. And we're not going to go through the really crazy ones or the ones that are super complicated that require you taking on a lot of audit risk from the IRS. What we're talking about today are hopefully items that most people could use. So hopefully we can work through several ideas today.
Well, and it's been brought up on a lot of our episodes is how taxes are going to be one of the biggest expenses for people over the course of their life. And so taking advantage of laws that are already in place and things that are already in place to help you with these, I think, is important. So a lot of people maybe don't know about it, and they're paying more in taxes than they necessarily need, which I don't think a lot of people want to willingly pay more taxes than they need.
Yeah, it's funny. Even those who are in favor of maybe potentially higher tax rates are also in favor of not paying more than they have to themselves.
Yeah.
They just want everybody to have to pay a little bit more, it seems. But yeah, both sides of the political spectrum, we're not talking about that today. We're talking about how do you use the current rules in order to pay the right amount that you are supposed to pay. I mean, that's the way I look at it is if this rule exists that allows you to pay less in taxes and you don't take advantage of it, well, that's kind of on you. Now, the other hard part about this whole process, I've seen a lot of memes out there when tax time comes around and they'll say something like, they'll have the interview with themselves. You know how that is now.
Yeah.
And they're like, hey, so I got to pay taxes. How much should I pay? And then the IRS is like, we don't do that math for you. He's like, okay, but so I just get to choose? They're like, oh, no. You need to get it exactly right. And if you don't, we put you in jail. But we don't. We're not going to tell you what it is. Yeah. But we already know, but we're not going to tell you. So it's tricky. Today, I think we dive into various strategies that will help people. And I think most of this is for folks who have invested some money. Because a lot of these strategies will revolve around having wealth. They also are available to people who are charitably inclined. There'll be some in that category. And mostly, a lot of this is going to be relevant to near retirees or retirees. But if you go back to your 30s and 40s, or those of you who are listening that are in your 30s and 40s, I think it's helpful to know these things because you'll know the tools that are available to you as you progress into those next stages of your financial planning life.
Yeah, and as we were talking about this a little bit in preparation for this, we had talked about, okay, you have your income, and then things start getting deducted off of that, and then you get to a certain point, and then there are other adjustments that you can make. And so I think that that's really beneficial if you could go through that a little bit.
Sure.
I have my income from various sources. What happens to that?
Yeah, so this is important. If you can get this very basic understanding of how a 1040 tax return is calculated. And I know there are so many parts to our tax system in terms of how we calculate it, but it can be boiled down to, and for me, it's very, very visual. If you can imagine you've got a 1040 on a whiteboard, right? Like maybe you decide if you want any visuals on this video, Eric, but this 1040 it's the catcher of all the other schedules and all the other returns and everything, even the business returns, everything, they all come to this 2-page, and Trump got it. This is funny. Trump said, I'm going to get it down to 1 page. And they did. This was his last administration, not the current one. Mm-hmm. They got it down to 1 page, but then basically all they did was they took a whole bunch of things and they moved them to Schedule 1, and then Schedule 1 now puts it on one line on the 1040. So it's kind of down to one page, and I do think that that's true because a lot of people don't have the Schedule 1 and Schedule 2 stuff. So the point is you've got Schedule 1, Schedule 2, Schedule A, B, C, D, E, F, all of these funnel in and some spot on the 1040. And then there is a line, it's line 11 on the 1040, that is your adjusted gross income. And literally they call it the line because it's that important. So anything that you can do to decrease the income you have to show on the line above the line is typically more beneficial to you than anything you can do to decrease below the line. So we're going to start right there at the line and tell you what's above it and what's below it. So, and I think we can keep that construct throughout this whole conversation.
Yeah.
And maybe help me remember to, if I forget, we need to tell people, oh, this is above the line or below the line.
With each of the strategies.
With anything we talk about, exactly. Now, there are about 3 or 4 things that happen that are very important. You add up all your income above the line. Then you get to adjust things from your income. And that's why they call the line adjusted gross income. Gross meaning supposed to be all of it, right? The gross is supposed to be like the large number. And then the net is after, deductions. But so it goes all your income, some adjustments, adjusted gross income, the line, your deduction, and that's where you're talking about a standard or itemized deduction. And then after your deduction, you have taxable income. And at that point, you just figure out what your taxable income is, you pour it into the different tax bracket lines, and that tells you how much tax you have to pay. And then at that point, you just say, okay, well, how much did I already pay because it was withheld from my paycheck or withheld from an IRA or 401k distribution or my Social Security? And then did I pay too much? Did I pay too little? Do I get a refund? That's that process. So again, it's pretty straightforward when you think about it this way as the line, adjustments above it, deductions are below it. Those are the 2 words. Usually they call it an adjustment above and a deduction below.
Okay. Yeah.
And then the funny thing, and this wasn't in our agenda, but a quick mistake people make. They file their tax return, they get a refund, and for some reason in their mind, they think, I didn't pay any taxes. Well, right, you didn't pay any taxes in April for last year, but what about all the taxes you had withheld during the year? I mean, if you want a refund every year and you withhold $100,000 of taxes and your tax bill was only 2, you can have a $98,000 refund.
Yeah.
You know what I mean? That's not ideal, and that's an extreme example, but don't mistake the sorting out or the netting out of your tax situation in April for whether or not you actually paid or did not pay taxes, because it's just a matter of reconciling how much you already paid versus how much you were supposed to owe.
I made that mistake as a young person. I was like,
too.
oh, great, $6,000 in a tax return. That's great. Like I'm doing everything right. And even older people than me were talking about how they were disappointed when they didn't get a big tax return. But once it was explained to me, I was like, oh, like it's you're kind of giving the government money for free to use when you could have.
Right. And I don't mind that. I mean, a lot of people look at that as like a forced savings. And of course, you don't get any interest when you give the government a loan like that. And that's okay. I guess I'm more concerned about the fact that people sometimes misunderstand what's actually happening there. They think that is their tax bill, whether they got paid taxes or didn't have to pay taxes, and they forget about the actual total tax bill. So I'd rather not think about what the result was in terms of additional payment or refund, and I would rather look at your actual tax bill, including everything, your withholdings and the additional you may have paid or got refunded, and then see if we can reduce that and work on that.
When you talk about adjusted gross income, AGI, at least in the Medicare side of things, a big number around that would be a modified adjusted gross income. So where do these modifications come into this conversation?
Yeah, great question. So we have that line, right? All your income gets added, and then they adjust some things out of it, and then you get to adjusted gross income, the line. And the government has said, well, we have all these different benefits or penalties, and we want to figure out which people should be eligible for those benefits and which people should be subject to those penalties. And in the case you're talking about, it's Medicare Part B and D. whether they have to pay more based on their personal income. So the government doesn't like to use AGI for that because they don't like the adjustments that happen before AGI.
Mm-hmm.
So what they basically do is they modify it by pulling back in some of those adjustments. So they're saying, okay, we're going to use AGI, but we're going to make sure tax-exempt interest gets pulled back in. Otherwise, all these retirees are going to buy a bunch of muni bonds, reduce their taxable income, and not have to pay those Part B premiums.
Mm-hmm.
But they have a massive bond portfolio of muni bonds that pay tax-exempt interest. So in order to prevent that from happening, the government says, we're going to make you include that tax-exempt interest in there too. So that's what Medicare is. Now, most of the time, people will say, okay, so my modified adjusted gross income is AGI plus tax-exempt interest. That means I could do a Roth conversion, or sorry, not Roth conversion, Roth contribution. It's like, well, hold up. That's a different modified adjusted gross income. There's actually six main modified adjusted gross income calculations. And the Medicare one you're talking about isn't even part of the six. You and I talked about that a bit ago.
Just makes it easy for everybody.
Exactly. Because I told you, I'm like, there's six. And then we went through, this is what calculation 1 applies to, calculation 2 apply, and you couldn't find the Medicare one. I'm like, oh, that's not on there.
Yeah.
that's a secret one. That's off menu.
Yeah.
It's like the In-N-Out animal style. It's like totally. Yeah. Do you know what I'm talking about there? They've got
their secret menu.
Exactly.
Yeah.
Okay. So there are six different modified adjusted gross income calculations. MAGI is the acronym. I don't think people need to know exactly how to calculate each one because it's basically always adjusted gross income plus some stuff.
Yeah.
And if you want to be safe, just start with the total income. And most of the time, that's helpful. Like if you're thinking about Medicare Part B premiums, just include everything. Mm-hmm. Just include everything in your calculation if you don't want to have to figure out exactly which things go along with it.
And then just high level, you'd brought up like Roth contributions is going to use one, Medicare is going to use one, kind of your ACA if you're in the marketplace from a premiums perspective.
That's six.
That's another one. I think different like Medicaid levels might come into there. So there's just the point is there's a lot of different things that are using different MAGIs to
and
figure
definition
out what
1 has the most.
Okay.
So the definition 1, I'm looking at a list of 8 different things. The child tax credit, like everybody gets a tax credit for each child, unless you make over $400,000 to $440,000 right now. Okay. So once you make over that limit between $400,000 and $440,000, you start to lose that child tax credit. And that's big too, because let's talk about that for a second. Difference between a credit and a deduction.
I was just going to ask that on where this is coming in.
Okay. So a credit is way later. So I didn't really explain that, but let's keep going. So we have total income, adjustments, which adjustments are great, credits are better. Okay. I'll explain how. So if you get to pick, you take a credit, then you take an adjustment, then you take a deduction. Not that you get to pick, but that's the order that you want those. So you add up all your income, make some adjustments, you get to the line, which is adjusted gross income. Take your deduction from that, you get your taxable income. Then they figure out, then you throw that through the different tax brackets, at 10, 12, 22 is what our current tax rates are, end up. Then they say, okay, Eric, you owe $10,000 in taxes. You have a credit. It's like a gift card. You have a gift card for the IRS right now with a credit of $4,000. So it literally just wipes out $4,000 of your tax bill, which is like getting rid of $40,000 of income if you're at a 10% tax bracket, right?
Yeah.
Now, I can just feel those comments coming through. No one's in a 10% tax bracket. I got plenty of clients that are in a 10% tax bracket. There are most people are a little more. So the point is, a credit just pays your tax bill and you want it.
Yeah.
And that's painful. Now, that's really good income, $400,000+ a year, but it is painful when you get to the point where they're taking away credits.
Yeah.
Because they gave you a gift card and then they took it back.
Yeah.
Okay, so that's modified adjusted gross income 1. That one has about 6 or 7 or 8 that we have on a list, but we don't need to go through all of them. But the things that it may impact are when you have income from investments and it's at a certain level, above a certain level, you have to pay an extra 3.8% Medicare surcharge tax on passive income. Investment income is what it is. So that's one of the Magi's, and Roth IRA contributions. And like you said, Medicare, also Affordable Care Act. So if you are getting a subsidy for Affordable Care Act, that will be impacted by a Magi.
Yeah. So we've kind of outlined what's above the line, what's below the line. And so at what point do people start to strategize and kind of manipulate kind of has a negative connotation, but they're controlling what income is showing up and where it's showing up on this.
I think you can, if you are careful and you control what you can control, you'll be able to impact your tax brackets and tax lines. So let me see. But your question is, at what point do you control it, or what do you want to talk about?
Well, I think that a lot in previous conversations we've had like the Roth versus traditional discussion that we had is like our most viewed video on this channel. And in that, you talk about how once you get to retirement, you have a little bit more control over what income you're pulling from to deal with. You talked about you have clients in the 10% tax bracket. Well, I think that you can control where income is coming in to immediately start to pay less in taxes than if you're taking from other areas.
Right. Imagine you're making $200,000 a year as an employee at a company. That income hits a W-2, and the government requires your employer to do withholding from that. So they calculate a withholding based on how many exemptions you claim, So all that whole process means that you have very little control over what's going on there. And that income shows up as one type of income. It shows up as ordinary earned income. Mm-hmm. It is subject to ordinary income rates, which are some of the highest. It is subject to FICA tax, which is Social Security and Medicare, 6.2 Social Security and 1.45% Medicare. And by the way, your employer is doubling that, paying those same rates as well. And if you are self-employed, you are both sides of that conversation, right?
Yeah.
So you have maybe a tax rate of 24% plus 15% FICA plus your state wherever you are. You can see how that's pretty expensive, and you have very little control. And then all of a sudden you flip the switch and you hop into retirement. It's not earned income anymore, so you don't have to pay any FICA tax, which is great. Mm-hmm. And you maybe have some Roth money. You maybe have some just regular investment accounts. Maybe you have a rental property. Maybe you have Social Security, which is not fully taxed. And the only thing that's really, not the only thing, one of the main things that is very heavily taxed at ordinary income rates is your pension or your IRA and 401k withdrawals that are in a traditional tax status. That's the money that comes out as if it was earned income. Hmm. Now, it doesn't have any effect, like you don't have to pay FICA tax on it. You don't have to pay that 6.2 and 1.45, but you do have to pay ordinary income rates. But if you're careful, see, this is the cool part about being in a retiree status, as well as thing that we get excited about as planners, is because we all of a sudden, you had one lever to pull while you were working. I want this income. I'll take it. I'll deal with the taxes. You flip the switch into retirement, and it's like we just put 5 or 6 levers on your dashboard, and we can kind of pull this one until we fill up the 10 and 12% tax brackets. And then maybe you decide, I'm done with that. I'm going to stop before I hit 22. And now I'm going to pull from my after-tax brokerage account, paying 15% capital gains on the growth of what we sell. And then you can say, oh, I'm about to hit that investment surtax. I'm going to shut that one off. I'm going to pull from my Roth for a little while. And you can really control the tax bracket so well if you are aware of where those lines are. So that's the key point here is when you get to the door of retirement, you need to know. You don't have to know about all of the lines, because there are many lines. If you make $150,000 a year, you don't need to know where the 37% tax bracket is up in the $600,000-$700,000 range. It doesn't matter. Yeah. But you do need to know about the lines right by you, and the first Medicare bump is going to be about $200,000. So if you do this $80,000 Roth conversion, you just pushed yourself into higher Part B premiums. So that's something you want to be aware of. Yeah. A few of the lines nearby.
And the big thing with the Medicare lines is they are, once you go over by $1, you've experienced the full penalty. Exactly. Versus like a marginal kind of tax.
Yeah, your world is mean. That's the only one that it's not, I'm just joking, but there are others, but there aren't that many. More of them phase out, and more of them are marginal, meaning A phase out is like the child tax credit where you pass 400 and they start to take a little bit of it until you get to 440 and then it's gone.
Mm-hmm.
So it is a percentage, however far you work as a percentage through the 400 to 440, that's the percentage of the child tax credit they're pulling back. Or that's the same thing with Roth contributions as you work through the phase out. Medicare, you cross that first line and they're like, we're just going to charge you more.
It's done. Yep.
Yeah, we're done. Marginal tax brackets work that like you pay 10% up to this line. And if you cross it, you don't have to pay 12% on everything. You just pay 12% on what crosses the line. Whenever you hear the word marginal, that's what they mean. Mm-hmm. They mean you're paying it on the margin or on the extra, on the next portion is taxed at that rate. So when you hear I have one last thing to kind of help people think through this. Effective tax rate is where you take your taxes and you divide it by your income. And it's kind of like your average tax rate.
Mm-hmm.
Marginal tax rate is the very last dollar you earned. If you make $200,000, the very last dollar between $199,999 to $200, that last dollar is taxed maybe at 24% or 22%. But your average rate might be 13.
Yeah.
Because there was income taxed at much lower rates.
Yeah. Is it a correct assumption or an incorrect assumption of someone entering into retirement and now they're pulling from investment accounts, that those would mostly be long-term capital gains eligible if they have been in a certain account for a year or more?
Yeah, I love the word eligible. I mean, yeah, anything could. I mean, in a portfolio, you could build it so that most all of your tax treatment is long-term capital gains, but there are some rules you would need to follow. So when you're managing, should we just kind of talk about some strategy? So right now, one strategy we're talking about is capital gains management and long-term versus short-term.
Mm-hmm.
So quick definition, you've got an investment, it goes up in value, you sell it, the difference, the growth, that's a capital gain, and there's going to be a tax associated with that capital gain. It is short-term, and this is, once again, we got to throw these things out here. This is not always the case.
Yeah.
There are little rules with employer stock, or there are little rules here and there with unique investments. But the majority of the time, the line is at 1 year. So if you have held it for more than a year, it's long-term, and shorter than a year, it's short-term. And it's probably worth saying, Eric, in general, the same thing. When we're talking about this stuff, we're talking very general, education-based. Yes. Please don't take this as Zacc told me in my situation, this is what I should do. Yes. We're not giving individual advice here. We're trying to talk about things that are correct 80 to 90% of the time.
Yeah.
Okay. So 1 year is the mark. Less than a year short-term, more than a year long-term. Short-term capital gains are treated as ordinary income. Okay. Long-term capital gains are at a lower rate. So the rates on ordinary income go 0 on your standard deduction, 10%, 12, 22, 24, keeps climbing up to 37. And then on long-term capital gains, there's a 0% long-term capital gain bracket, which a lot of people don't realize. If you go a year where you're sitting at a 0% capital gain bracket and you have long-term capital gains in your portfolio and you're not purposefully logging those meaning selling some of the investment at a long-term capital gain, you just missed out on a huge opportunity, because someday later you may be beyond that 0% tax bracket and you then have to sell it at a 15% tax, because 15 is the next line. So knowing your tax expected rates in the future versus today is huge. I actually do this every year with my kids' accounts. They have their own little space of 0% tax, and I have custodial accounts for them, and I go in and purposefully log a couple $1,000s worth of capital gains because it's at a 0% tax bracket, and I don't want to wait until they're 20 years old going through college and maybe they're outside of that 0% bracket and we're selling at a capital gain when we didn't have to if I just inched away at it each year. For a couple, that's close to about $80,000 of income, and any income you have takes away that. So let's say you're earning $40,000. Well, you only have about $40,000 left of 0% tax bracket.
With long-term capital gains.
Okay, so there's the 0, 15. Then once you hit that Medicare surtax, you have to pay another 3.8%. Technically, the long-term gains bracket is 0, 15, and 20. But I don't think that that's the right way of looking at it, because you hit that 3.8% additional tax before you get to the 20. So in my mind, there's an 18.8 bracket in there. Even though when you look it up online, you won't see it written out like that. I think it goes 0, 15, 18.8, and there is no such thing as a 20% tax bracket for long-term capital gains, because if you're at 20, you're at 23.8 because of that 3.8% Medicare. So real lines in my mind are 0, 15, 18.8, 23.8. And then your state rate on top of that.
Yeah. And if we're okay to transition a little bit off of this too, another strategy that I hear a lot is just go heavy into dividend paying stocks, because then you're just drawing the dividends and you're not taking away from the principal. So where do dividends kind of play into this strategy of that?
Yeah, dividends are going to be classified as qualified or non-qualified. So this is a really great strategy. That's the second in terms of like this category is we're managing an investment portfolio that's not an IRA. That's another thing I hear. Like people will read, oh, I heard I need to go into dividends because they're treated from a tax standpoint better. Well, not inside of an IRA. You're just going to be taxed when you pull out of that thing. There's no tax effect on those dividends in the meantime, right? So we're talking about non-retirement accounts. They get dividends, and they'll be classified as one of two things, either qualified or just ordinary. If they are ordinary, they're taxed at ordinary income rates. If they're qualified, they get to be taxed at long-term capital gain rates. So most things will be funneled to one of those two stacks of income rates. To be qualified, you have to hold the stock for a period of time around that dividend. We're not going to go into all the details around what's called record date, ex-dividend date, and payout date, but those are 3 dates around a dividend that they use to control people from chasing dividends and buying and holding for a day and then selling and getting the dividend in the meantime. That's a conversation for another day, but the point is 60 days before that date, and those 3 dates are really close together. So let's just say it's about 60 days before that cluster of dates and 60 days after. You have to hold it. So it's 121 days. You have to hold it for 60 days within that window. And if we're talking about preferred stocks, it's 90 days on either side. But those are super less common. So you hold it for 60 days in that 120-day window. And it's a U.S.-based company or a qualifying foreign company, which makes it very clear for everyone, right? And then it's not, my favorite one is the third qualification, which is, and it's not disqualified as a payment. Okay, you just gave me 2 super ambiguous clarifications of this rule. Anyway, so the point is, if those things qualify, it will hit long-term capital gains. And when you get your 1099 from your brokerage firm, this is on the 1099 DIV. So most of them do what's called a consolidated 1099. They put several different tax forms on one. So the 1099 div is the section. It's usually the first section on the consolidated. There's also like 1099 INT for interest and 1099B. I call it B for brokerage transactions. That's not what it is, but that's how I remembered it early on. That has to do with all the buys and sells that you've done in capital gains. But the 1099 div in box 1 will tell you your total dividends, and then it will show you the qualified portion in the next box. So it's important because some people look at it and they're like 10,000 of ordinary, because it calls it ordinary. So they're like 10,000 of ordinary, and then they see 7,000 of qualified, and they think they had $17,000 of dividends. They didn't. They had 10 total. They put all of it in that box 1, and then they show of that portion how much was qualified. So they only had 3 in ordinary that is taxed at ordinary income rates. So if you can control, like thinking about your dividends, if you find that you end up with a lot of non-qualified dividends, it's time to be looking at the portfolio a bit and wondering, like, am I trading too frequently? So I'm not holding the position for a long enough period around that dividend date? Or am I buying investments that are not qualified in the first place? And if you find that that's you, then you just need to look at the list and figure out which ones are paying the biggest dividends and figure out why they're not showing up as qualified. Now, it might not be your fault. You might be buying a mutual fund or an exchange-traded fund, and inside that fund, they're not making the decisions that qualify you for them to be qualified dividends. And then they just swap out the fund for another one.
So as we're talking through all of this, controlling our marginal tax rates through long-term, short-term, qualified, non-qualified, all of these things, is this an above-the-line exercise that we're dealing with?
Oh, yeah. Thank you. It is above the line in the sense that there is opportunity for the income to never show up in the first place.
Mm-hmm.
So yes, that aspect of it is above the line. But long-term versus short-term capital gains is not above the line. Ordinary income versus capital gains rate on dividends it is an item that gets listed above the line, but all of that income will be included in the line. And then later when they go calculate your tax bill, they basically do this separate worksheet that says, hey, this portion, we're going to subject it to this lower tax rate because it's long-term capital gains. So it doesn't really affect the line. So like if you're thinking about the MAGI calculations and eligibility for things, whether it's qualified dividends or ordinary dividends, that's not going to help you on a MAGI calculation.
Okay.
But it does help you later because they're going to go say, okay, hold up. Before we calculate the exact tax bill, it's like towards the end, we're going to split these out. And this piece is taxed at a better rate.
All right.
Which I think is a confusing way of doing it. I wish they would like branch it off early and then let's figure it out from there. But it's fine.
Every part of the tax code is confusing to me. So I'm glad that you're here to clarify all this.
Also, there is a way so that capital gain harvesting. Okay, so let's just run through a couple. We're talking about taxable investment portfolios and several different things that you can do.
When you say taxable investment portfolios, can you make that even simpler for me?
Yeah. This is money that's not sitting inside a retirement account.
Okay.
And you've decided to buy stocks or bonds or funds or other public investments through a brokerage firm like Fidelity, Schwab, Vanguard, or maybe you're invested with an advisor and it's held at LPL or a Edward Jones or those types of things, right? Okay. You have money sitting in one of those accounts and it is listed as like a joint account between you and maybe your spouse, an individual account in just your name, or a trust account that you set up. All of these none of these are retirement designated portfolios.
Is it what a custodial account for your kids?
Yeah,
fall into this?
Exactly. They're taxable brokerage portfolios. They're just owned by a kid instead of by an adult.
Mm-hmm.
But it doesn't. None of them have this tax deferred status where we'll deal with taxes in the future when I take it out.
Yeah,
that's not how it works. You got to deal with taxes every year on those accounts.
Okay.
And then a Roth is I'll deal with the taxes now, and then I'll never think about them again. Right? Yeah. That's the opposite.
Okay.
These accounts are completely underrated, like so underrated, and a lot of people are like, well, I wish the government would let me save more money because they only let me put $7,000 in my IRA or, $20,000 or $30,000 in my 401k. You can put $1 million a year into a portfolio like this, buy investments that pay tax-free income. Now, you're going to get a lower interest rate when you buy tax-free municipal bonds or something like that. But there is so much control, which we're going to talk about a few ways to control. I know many financial advisors who basically say, go get the free money from your employer and then be done with all the retirement accounts. And just double your money on the match and then drop everything into a taxable brokerage portfolio. And not only that, I see some of the wealthiest people that we talk to, because of those contribution limits on retirement accounts, their taxable brokerage portfolios are the biggest portion of their wealth.
Interesting.
Because you can only put in I say only, and I don't want to be insensitive to the fact that $30,000 a year is a lot of money to be putting away, right?
Yeah.
But if you are making $500,000 a year and you want to save 20% of your income, that's $100,000 a year, and you can't put all that in retirement accounts. So those people put another $70,000 in their brokerage portfolios, and then those things compound. And if you manage taxes well, you can have a really low tax rate on your brokerage account.
How do you manage taxes well in this scenario?
Yeah, so let's go through several different ideas. We briefly mentioned capital gain harvesting. So if you are sitting at a space where like you have a really low income year, some people's jobs, self-employed people, actors, Actors have really cool opportunities because they make a lot of money and then they make no money for years, and then they make a lot of, and so that kind of variability creates opportunity in financial planning. So that kind of variability means there's a 0% capital gain bracket. So if you had somebody in that situation and then over here you have capital gains, you could take $80,000 worth of capital gains. Now let's just do some quick math and think about this. Let's say you had an investment that went up 10% in value, and that was going to create $80,000 of capital gains. That's an $800,000 investment. So in order to log $80,000 of capital gains, I'm actually selling $800,000 worth of that portfolio.
Wow.
And I'm logging that gain, and now I have $880,000 sitting there that is completely after tax because we've already logged that. Now, if I wait till that $800,000 doubles to $1.6 million and then I want to start selling, that's not going to work. You don't have that kind of room in the tax brackets. In fact, you're going to be at that 23.8% tax bracket. So more than just the 0% harvesting, someone might say, I'm actually also going to harvest inside the 15% tax bracket because in the future, I think I'll be subject to 18.8 or 23.8. So you're thinking, I'm going to go ahead and purposefully log, which all of this is completely opposite from most financial advisors who are like, tax loss harvest, like over and over and over again. Yeah. And there's a place for that. But I actually think financial advisors get overly excited at times about tax loss harvesting. So let's talk about what that is real quick so people know what we're talking about.
And I've heard this a lot in, like, again, I'm not a financial advisor, I'm not in that world, but just in my social feeds that come up, it's always advisors talking about if you're not taking advantage of tax loss harvesting, your advisor isn't doing anything for you and blah, blah, blah. So it seems like it's this differentiator that a lot of advisors like to lean on to persuade people to use them. So what is going on here, and is that big of a deal?
Yeah, I'm glad you said social feeds. I thought you were going to say in my social conversations, and I thought, like, Eric, I don't know if
I don't have that many friends.
That's what you should be talking about when you're out and about. Tax loss harvesting is the concept of the fact that all your investments don't move perfectly up at the same rate. I mean, if they did, there would be no need for tax loss harvesting. They would just go up together and we all make money and everybody's happy, you pay taxes. Tax loss harvesting is the investments move at different, my fingers are representing all the different investments.
It's perfect.
It's perfect. This one may be down. So you take this one investment and you purposefully sell it because you have another one over here in the future that should be at a gain, or another one that is currently at a gain. You can sell this one at a loss. You can log that loss, and the government will let you use up to $3,000 a year against ordinary income. Now, I would do that every year on purpose for sure because, unless I'm harvesting gains. You can only do one, right? Because they all net out. If you harvested $40,000 of losses and you think you're filling up $40,000 of capital gains, and so you sell $40,000 of capital gains, you just got to a zero because they all net out on the tax return.
Okay.
So you have to pick which route you're going to go each year and sometimes over multiple years. But let's say that you have an investment at a loss, you can sell it, and you can use up to $3,000 against income every year. I worked at a spot where we had some pretty big clients as well in my previous employer, and this one had like $25 million in a portfolio. This was 2008. Markets dropped, and that kind of portfolio loses quite a bit of value in terms of millions of dollars just on a percentage basis.
Yeah.
So we harvested $7 million of losses during that year. And some people who may not understand the reason why will look at that and think he'll need to live multiple lifetimes, in fact, crazy number of lifetimes, to get the $3,000 back that you can take every single year against ordinary income. That was never the plan. So the secondary benefit of that is you can use it to offset an unlimited amount of capital gains in the future. And those losses carry forward every year like a little piggy bank that you can just chip away at each year as much as you want.
So if I harvest that this year and I've got $7 million of tax loss availability, that means that next year I could use $1 million of that, and now I'm down to $6 million to use in year 2, and then
Exactly.
Okay.
Exactly. So let's say that you did all that and you used up all the losses. the argument against this whole idea is, okay, so I wasn't going to pay any taxes if I didn't sell, and I sold, and then I used it when I sold other things with gains, and I didn't pay any taxes anyway. I'm no better off, right? Yeah. So the biggest benefit is that $3,000 against ordinary incomes, because you're literally changing an ordinary income rate for a capital gain rate in the future. You're saving on ordinary income today, and you're benefiting by paying a lower tax rate later. Anytime I can procrastinate paying and get a lower rate, we'll take it, right?
Yeah.
Now, what that did, though, for that particular portfolio is it completely unhandcuffed us from trading in the future for the next 3 or 4 years. And by the way, all $7 million was used up in about 3 or 4 years. So he had completely used it all up because of capital gain distributions that you can basically say like, all right, well, I'm not going to have to pay taxes on long-term capital gains or other capital gains that get pumped out of the funds or investments. Also, if an investor comes to us and says, I'd like to get a little more conservative. Well, it's really hard sometimes when all of a sudden we have to tell them, great, if we do that, you're going to pay $50,000 in taxes. You okay with that? Because we have to trade some things to get you more conservative, and you've made great money on these stocks. Those are the things that we need to sell in order to get a little bit more conservative. How do you feel about that? And sometimes they'll say, never mind. Never mind. I don't want anything to do with that. And if I do that, it'll increase my Social Security taxability or my Medicare premiums. So all of those downstream effects of having that capital gain can be at least delayed or avoided for quite a long time if you are willing to do some tax loss harvesting. And it basically just takes handcuffs off. And they say, don't let the tax tail wag the investment dog. So you should be thinking about risk, return, taxes in that order.
Okay.
I don't want to take on unnecessary risk. I want to make as much money as possible, and I'll deal with the taxes associated with those two. I need to minimize taxes. But sometimes people will throw the taxes emotionally. They'll throw it right up there at the top, and then all of a sudden, risk and return. So the benefit of tax loss harvesting in my mind is $3,000 against ordinary income, take the handcuffs off portfolio management. That's what you really get, because you're just delaying the capital gain. And then if you delay it all the way till you die, nobody pays taxes on it because you get a step up in basis. Okay. So
this is all above the line, below the line. What
kind of all above the line, right? Because we're just making income disappear. We're making it so it doesn't show up in the first place above the line.
Nice.
Yeah, we haven't really talked about anything below the line. So when it comes to, we talked about fund distributions. Like I mentioned that you can control that with some loss harvesting a bit. You can control it better by picking the right funds. So you pick funds that don't. So it can be really frustrating. You can have a mutual fund, and generally you may know this. I generally struggle with mutual funds in general. Don't love them. ETFs tend to be more tax efficient in general. Distribute less. When you get a distribution, that sounds good. But in order to discourage people from chasing those distributions and dividends, they actually lower the price of the fund by the exact amount of the distribution temporarily. And they wait for that to come back, hopefully. So let's say you have a $100 per share fund and they're paying a 10% distribution. Sounds great. You're going to get 10% of your investment as a cash distribution. They're going to manually push the share price down to 90 in order to discourage somebody from buying it, holding it a day, selling it, and getting out, because they'll actually lose $10 on the share price, gain $10 on the distribution. They're no better off, so people stop chasing those dividends that way.
And then eventually the hope is that 90 turns into 100 again with an 11%
if you hold it.
Return, right? But then as the counter argument, if I'm not doing dividends, I was at 100 for the share price, and that also went up by 11% that the 90 had to get to, so I'm ahead over there too.
Yeah, exactly. And if I'm going to be net neutral on around the dividend, the only difference is now I have to pay taxes on 10% of my investment if I get a distribution. Whereas if they don't give me a distribution and they don't have those distributions inside the fund, then I don't have to pay taxes on it. And it's too much for today's conversation to talk about the mechanics of how these funds are different. But inside there's an opportunity, and the mechanics of how they're structured makes it so that in one scenario, they are forced to tell you this is how much of a gain we had. Whereas in the other one, they're not trading as much on the inside. So they don't have as many of those gains because of the way that investors interact with the fund. So again, too much for today, but there's a difference. So the point is you look for funds potentially that have lower distributions and have a similar growth rate overall. And that'll help you. Or if they do have distributions, ones that tend to do it at like long-term capital gain distributions instead of short-term capital gain distributions.
Right.
So that's managing fund tax efficiency. And there are metrics called like tax cost ratio that you can look at a fund and see like, oh, this is what the actual cost of owning this fund from a tax standpoint is.
Okay. We do have a lot of DIYers that are probably going to be looking into that specific.
That's hard to find too. You got to look pretty deep for that tax cost ratio. If you are at places like Fidelity and Vanguard and Schwab, go to their fund research sections, click on the fund ticker, get to the data and stats that they provide, and then that's the thing you're looking for is tax cost ratio. Doesn't matter if you're sitting inside an IRA. I mean, it's super important that people understand that. Don't be stressed about tax cost ratio inside an IRA. Okay, so that leads to the next category, which is asset location, which is different than asset allocation. Asset allocation is how much stocks, bonds, real estate, whether you like crypto, precious metals, like all those things. How much of all of those categories should I have? Asset location is I want this much of those categories. Which tax structure should I put them in? Like if I have a Roth, traditional, after tax, which one should get my bonds? Which one should get my dividend stocks? Which one should get my high growth investments, my small cap growth stocks, or whatever it may be? The idea is you can take your income producing investments, put them inside your traditional IRA accounts, and that will, those are going to be taxed as ordinary income anyway. So at that point, you don't care. Like if you get, in fact, you're happy to have high paying ordinary income investments in there because you have no tax liability until you take it out anyway.
Yeah.
But inside your after-tax brokerage account, we want to get long-term capital gains where we can. So we're going to say buy the things that you don't have to sell for a long time. Buy the things that distribute only qualified dividends as much as possible. You can't be perfect on that. And long-term capital gain distributions. That's asset location. A word of warning a bit on asset location. Sometimes I feel like the people who watch these types of videos are like a little bit extreme. I am too. But they're like, okay, then I'm only putting this investment in this account and only this investment in this account. The problem with that is when it comes time to rebalance across asset classes, if you don't have a little bit of everything in each of those accounts, you can't move from stocks to bonds if all your stocks are in your Roth and all your bonds are in your traditional. You can't like move money between those accounts. So sometimes it's nice to do like still have a portfolio, like a little bit of everything in each account, but emphasize like maybe in your Roth, you have more stocks than you have other things or more high growth than you have low growth, but you maybe have some of those other things so that in the future you can control the allocation within each account.
Yeah, and if people want to go on a little bit more deep dive onto what you're talking about right here, we do have a video where you go through the different asset classes and the different types of things going on here. So I think that one, we can have that pop up.
Okay, so the main four on managing a taxable account efficiently: tax loss harvesting, capital gain management, capital gain harvesting, and then asset location, and then fund distribution, fund tax efficiency.
And all of these are making income disappear above the line.
Mm-hmm.
Perfect.
Yeah, good way of making it disappear. Yeah. Or, okay, so it's either making it disappear, or if you have to take it, when they finally do that like final split, it at least pushes it over to the long-term capital gain rates, which are usually about 10% less than the ordinary income rates.
Cool. This next topic, I think you're very passionate about, and it could be a video all on its own, which, spoiler alert, we might do. But if I'm charitably inclined, there are ways from what we've talked about in the past where I can do that more tax efficiently.
Most people give cash. And I think that's wonderful that they're giving. It's the worst way to get a tax benefit from it. So keep giving. And if that's all you can do, wonderful. Do good in the world. That's great.
And there's a part of people, I think, that will go, well, if I'm giving for a tax benefit, that's not the purpose of me giving. Right?
Correct. And it isn't.
That's not the moral reason why I'm giving something up.
Yeah, and we're going to spend a decent amount of time here talking about how to improve your taxes as you give. But make no mistake that giving is for giving purpose and philanthropic endeavors and like do good in the world. Wonderful. But as you're doing good in the world, let's try to minimize the tax burden over here.
Yeah.
It's a secondary issue. It's a secondary concern. But my job is to think about the secondary concerns while my clients think about the primary concern.
Yeah.
Okay, the secondary concern here is how do we minimize the taxes? If you are giving cash, that's great, but you are getting a tax deduction if you itemize. Okay, so here we are. We just crossed the line. We're at adjusted gross income. We crossed the line. At that moment, on your tax return, you start to calculate two different tax. And you don't know this. Most people don't. Not you in particular, but I'm saying the individual doesn't know this. You are doing an assessment of the government's letting me subtract a certain amount of income. That's called a standard deduction. Or I can add up all these things that qualify as deductions. And if they're more than the standard deduction, I will itemize them and take the itemized deduction. Or if they're not more, I'll just take the standard deduction. So charitable giving may be of no use to you tax-wise if it does not exceed your standard deduction. And there are three main things that exceed the standard deduction when added together as itemized that typically beat the standard. And it's charitable giving, it's state and local income tax. The acronym for that is SALT, state and local income tax, mortgage interest, those three. There are others, but if you tell me those three numbers, I can guess with a really high confidence whether or not you're itemizing or taking a standard deduction. Your state and local income tax is limited to $10,000 a year. That was a blow to a lot of high income people in especially New York, California, high income tax rate states, because somebody making $100,000 in those states is paying $10,000 just in state income tax. They also have property taxes on their home, and they have other taxes that they don't even get to count. So they only let you count $10,000 there, which was brutal. If real quick tip without going too far, if you are a self-employed person, like if you have an S Corp, you can actually in some states pay your personal state income tax with your S Corp, take it as an above the line deduction. So you just moved that from below the line to above the line by paying from the business. The business takes it as an expense, so it just evaporates. The income evaporates.
Right.
But these hand motions today, I can see you watching my hands today, by the way. I don't know. So the point is it takes it from below the line to above the line, evaporates it because it's an expense for the business, and only the net income from the business flows from the Schedule E over to the 1040. We talked about all those schedules. They flow to the 1040. And you just made it a race above the line. So that's wonderful. That's a little side tip if you are self-employed, S Corp, especially. That's the way I work through it. Okay, so then we're talking about state and local income tax, charitable giving, and mortgage interest. So the charitable giving is the one you can control the most because you can't really control the timing of your state tax payments that much. Some people will try and push it like to the next year barely and double up and control that a bit on state taxes, but it's a little difficult. And then mortgage interest is what it is as you pay your mortgage. So the charitable giving is the one you can control a lot. So if you are, let's say you have $10,000 of state and local income tax, you don't have a mortgage, and you give away $5,000 to a charity, and you're married filing jointly, that did not help you at all. Standard deduction is closer to 30. So, and you could take 15. You could subtract 15 from your income because of the state and local income tax plus the $5,000 charitable giving, or you can take the standard deduction of 30. You're taking that every time.
Yeah.
So that's the first thing is make sure that you actually are getting a deduction for it. And we'll talk about what you can do later here in a second if you're not. But the first thing is, let's say you have that after-tax brokerage portfolio we've been talking about, individual, joint, trust, and you purchased a stock. Maybe you're lucky enough to get on NVIDIA years ago, and that thing has 10x'd over the last whatever period that you owned it. You could give NVIDIA instead of cash. And because the charity doesn't have to pay taxes on capital gains, when the charity sells NVIDIA, it's none of your business. They own it at that point. So you don't have to pay taxes on that. They don't have to pay taxes on it because they're a charity. and you still got your deduction. If you give $5,000 worth of NVIDIA or $5,000 worth of cash, it's $5,000 worth of a donation. You get to deduct that donation from and add it to your itemized, but you don't have to pay the taxes on the $5,000. So that's the appreciated securities or appreciated asset donation.
And I'm just donating a share of NVIDIA or 2 shares of whatever stock to this charity and saying, here, have it. And then they're responsible to deal with it from there.
And there's some technical aspects of it, like the actual value of what you're supposed to deduct is like the average of the high and the low of that day, or the open and close. I can't remember. I'll have to look it up. But the point is, it's not that hard. If you have a good advisor, they can help you with some of that. Oftentimes, the charity will send you back a confirmation, but many times they'll say, we got 5 shares of this stock. That may not necessarily give you the exact value that you get to deduct. So that's the only part that gets a little bit more complicated. And then it's easier to write a check than it is to send stocks or shares to an entity. Big charities have brokerage accounts. So they're sitting there waiting, and they receive daily transfers of appreciated securities into their portfolios. They're very accustomed to it.
I was going to ask, what is the vehicle for that? Of like, how do I, if you have a charity and I have a stock, how do I pass that to you?
So let's say your stock is at Schwab. Then you go to Schwab and they will have a form, and this kind of transfer is a push transaction from Schwab to the charity's account. And frankly, many big charities have brokerage portfolios at all the brokerage firms. So if it's a really big charity, they have a Schwab account or a Fidelity account, and a Fidelity account probably. So in that case, you work with the charity, find out what transfer instructions should I send it to, where's your brokerage account, what's the number of the firm. It's called a DTC number. That's for like direct transactions into where you push it. So you at Schwab, you go fill out a form, say, I want to move these shares. And by the way, you're picking specific lots, LOTS lots. Those are the purchases at a certain price on a certain day. You do not want to give away the ones that have just a little gain. You want to go in and pick the exact shares that have the biggest gain possible, and you give those away. Okay, so you then fill out this form, transfer form, and then if the charity has an account at the brokerage firm, they just journal them from your account to their account, and it's done. But if they don't, then they do a DTC transfer from Schwab to wherever the brokerage account of the charity is sitting. Okay. Not too bad. Again, we do this regularly. Our financial services team has this down for many charities that are common here. So yeah, it works well. That's donating appreciated securities. That's below the line because you're adding it in as an itemized deduction, hoping it's more than the standard deduction, and then it will reduce your income. It does not reduce your AGI, MAGI. So giving money to a charity does nothing for your Medicare Part B premium.
Yep.
The next one does.
All right.
So, and it's still within the charitable giving world. The next one is a qualified charitable distribution. You are eligible to do this at 70.5. You are required to take money out of your IRAs at 73, or depending on your birth year, it could be different. But at some point, when you get old enough, you can take money directly from your IRA, and you can say, don't give it to me. Don't even write it out to me. Write the check out payable to my charity over here. And either they will send the check directly to the charity, or they'll send it to you and you just carrier it over to the charity. And as long as you don't take possession in the form of putting it in your own bank account, then that can be a qualified charitable distribution, QCD, and it just evaporates. It's a great above the line item because instead of you taking an IRA distribution of $10,000, putting it in your bank account, writing a check to the charity, getting a receipt, adding it as an itemized deduction, hoping it surpasses the standard deduction. You can go through all that process. Or you can just have it go IRA to charity, and then you don't even have to show it on your income above the line or at the line.
Nice.
Yeah, so what will happen there is there's a on the tax form, there's a spot where you put all your IRA distributions and then the taxable portion. And so if, let's say you took $100,000 out, but you gave 10 to a charity, then 90 would show up on the taxable portion. And then there's this little spot in between that you write QCD.
And I think to your point of like, even if that charitable contribution or distribution did push you over the standard deduction limit, it's still not as helpful to you as the fact that you were able to take it out above the line.
Yeah, because you get both in that case, right?
Yeah.
You make it evaporate above the line and you get the standard deduction. So you might as well.
Yeah.
I mean, imagine somebody is looking at a $10,000 distribution, and let's say with the distribution they get to $31,000 of itemized, and over here they have $30,000. Really, only the last $1,000 of donations was beneficial to them.
Yeah.
So they could do a $10,000 QCD and a $30,000 deduction.
Yeah.
So that's qualified charitable distributions. There comes a point, if you have IRAs, if you have after-tax brokerage portfolios, there comes a point where we have a lot of tithing payers in our state, a lot of religious folks that will pay to their church. And we oftentimes joke like, you need to stop paying your tithing. We're now in charge of that. Yeah. So we either needs to come from your brokerage portfolio, it needs to come from your IRAs, but depending on your age and what's available to you, like there comes a point where we're now in charge of it and it'll be okay.
And those large churches have brokerage accounts.
Oh, absolutely.
Yes.
Absolutely. They have there's a donations in kind department at the one here locally, the prominent church here in Utah. And that entity has many employees that know these processes very, very well. And we become very familiar with the charities our clients use.
Nice. The one question on that is you mentioned like if I do a qualified charitable distribution or any charitable contribution, whatever that is, let's say that in 1 year it's $5,000 and it doesn't really benefit me either way. Is there a way to add on years
bunching
for that? Okay.
Absolutely.
Okay.
Yeah. Bunching is one of our main last strategies here. So let's say that you have this $30,000 deduction for a couple.
For the standard deduction.
It's just available to you because you're alive. You get it. Yeah. So if you're giving to a charity from a tax standpoint, we want it to be more than that. But if you're only giving $5,000 a year to charities, it might be hard. I'm going to use a different number because it'll make it better. Let's say you're giving $15,000 to charities. Even in that case, it's still going to be really hard if $10,000 state and local income tax, maybe a little bit of mortgage interest, and $15,000 to charity. You might just be basically even with the standard deduction. But what if you gave 2 years of $15,000 in one tax year? The second $15,000 stacks on top, and now you have a deduction of $45,000 in 1 year. Next year, you take the standard deduction of $30,000. So if you did that every other year, you go 45, 30, 45, 30. Those are your deductions every other year.
You're getting an extra 15
every other year.
Yeah. Mm-hmm.
If you're at a 20-something% tax rate, you're saving $3,000 every other year, an average of $1,500 savings per year. Mm-hmm. So that's worth it, especially if you're willing to do it. Just if you have the cash, just to maybe donate a little bit more, like right away in that year. And now the tool that I love that really facilitates this is a donor advised fund, which is just your own little charity account. And you can drop 2 years worth in, but you don't have to give it to the charity. You can invest inside there, and then you can make monthly distributions. You could do they're called grants. You can do a grant of all of it right away. You could do a grant of half of it, and then next year the other half, because that's the timing you were paying on before anyway. But the little donor advised fund becomes a really cool tool to manage bunching. It also, some charities, if they're not super big, they are not equipped to handle stocks and bonds and complex assets. They're like, hold on, we're just a little mom and pop charity here. We don't even know how to transact all of that. A donor advised fund is designed to facilitate that. So you can drop the stocks in there. You can sell them inside the donor advised fund because that's a charity. And then you can do a grant, and the charity gets cash. You get to donate appreciated securities. You get to control the timing. When you're trying to separate the timing of your deduction from the timing of the grants to the charities, putting a donor advised fund in the middle of that controls the timing of both of those.
Is that because potentially I could send a stock to the charity and then they hold on to it for a long time and don't sell it? Or does that not come into play?
Selling doesn't matter. It's just you're not giving it to the charity yet. So and when you say they, it's actually you, because you are what's called an account holder. So like the big brokerage firms have these, Fidelity and Schwab, and local outfit here in Utah called University Impact has been really great for this as well. But you put the money in this donor advised fund, you're still in control of what happens to it, but it's not your money anymore. Mm-hmm. Like it's the charity's money.
Yeah.
but you got a deduction for putting it in there.
Mm-hmm.
The control you have is in what to invest and when to grant. That's your control.
Yeah.
You can't take it back. You got a deduction.
Well, and I was
for
thinking if I didn't go the donor advised fund route and I just sent them the stock, am I beholden to when they decide
Not
to
at all.
actually sell that?
And they won't even tell you. You'll never know.
Okay.
Sorry, didn't answer your question right then. Okay, so if you send it to a charity, then your deduction and your donation to the charity are married together.
Mm-hmm.
You don't get to separate. You can't be like, I gave that to them this year, or I want the deduction this year, but I'd actually like to give it to them. I'd like the charity to have that money in the future.
Yeah.
That's where those things are joined and can't be separated until you insert a donor advised fund in the middle. And now take the deduction, hits the donor advised fund, and maybe you give that money to that charity in 5 years.
Mm-hmm.
That's where you're able to control the timing of the tax deduction and the actual grant.
Gotcha.
So that's the donor advised fund. It's not a strategy in and of itself. It is a facilitator of the other strategies, appreciated securities and bunching.
So again, I just want to reiterate as people watch this, if you're willing to donate to a charity, that is amazing. That is the primary reason. And then there are efficient ways to do that.
Totally.
Yeah. You can donate more to charities.
Exactly. That's usually what happens. Yeah, is usually you're willing to give this much, but if you were willing to give 10 and we could turn that into 12 because of tax savings, would you be willing to give the same amount and actually have 12 to use?
Yeah.
I mean, that's another way of improving the world that way. I have clients that are closely tied to specific charities that are smaller and do like very specific missions for improving like water quality and availability in third world countries and like school and health and education and hygiene education and things like that. And they're working with a very small charity, but they can take from their own brokerage portfolio, drop it in a donor advised fund. The donor advised fund can help fund that charity, and maybe all the medical supplies that they're wanting to take to this area of the world, they could completely buy all of those. Like that's the kind of control that can exist with a donor advised fund paired with a smaller charity, which is kind of cool.
Yeah, that's awesome. What's next? What other opportunities? And it sounds like that one you have a little bit above the line and a little bit below the line as we were talking through that. So
yeah, you're trying to do anything you can above the line, right? QCD, do it. When you get to the point where you have to take minimum distributions out, a QCD is better than doing itemized deductions of stocks and things like that. Okay. So you're basically picking which one's best and which ones are available to you. But you're right, some are above and below. And then we basically have like several different, what we're considering like slightly, these aren't crazy advanced, but they're slightly more advanced or more involved tax strategies for retirees and investors. So this is kind of like a category 4 that we've been in.
And I think this is going to be a little bit of a wrinkle here, so I hope you're ready for this. I think that we throw in a secret keyword right now, just before we get into the advanced. Usually we leave it to the very end, but if they've made it this far and they're ready to go to it, they deserve the word. So what is this?
So every time you ask me and every time I have no clue what to say, because I'm thinking about taxes and not this stuff, but I actually prepared this time.
Yes.
So I want to know, what was the equipment of music listening? Like what was the device or system you used, let's call it in high school, end of high school? Were you on 8-tracks, records, CDs, Walkman? Like, did you have an MP3 player? Like, or where are we at? Like
a phone?
Exactly. I didn't in high school. I don't know if you did.
No.
You didn't. Okay.
No, not that you could play full songs. You could get like ringtones that were sections of songs.
I'm saying I didn't have a phone in high school.
Okay. Yes.
We're only slightly different in age.
I didn't have a smartphone in high school.
I can remember a lot of times we're just driving around being like, I don't know where any of my friends are. Well, I guess this night is shot. Let's just go home. There was no way to find people. Okay, so let's. I want to know what your medium of music listening was in high school. You made it this far. Congratulations.
And now we'll go into the advanced tax planning opportunities.
We've talked a lot about Roth conversions, and that sounds like a simple thing. It is so not a simple thing. And we've had a lot of conversations with people trying to figure out how to determine what is the appropriate or optimal Roth conversion strategy, because it's a multi-year analysis. Like there's an opportunity potentially for some people to do enough Roth converting that they don't ever have to pay taxes on their Social Security income later. That's a pretty big bet. You have to convert a lot. How do you calculate that against the idea of maybe I just fill up the 10 and 12% tax brackets versus the idea of I shouldn't convert a thing because I'm always going to be at pretty reasonable tax brackets. And the reality is that third one happens more often than you would think. And as we get into the analysis, we find often that we'll have someone come to us thinking they have to be converting a lot, and then we'll show them what their effective tax rates are expected to be throughout retirement. And they're pretty surprised at how low they are. Now,
and the conversion hurts more than it will actually help them.
Yeah. Again, comments, everybody's going to say, how can you imagine tax rates not going through the roof? Like, of course, there's a high probability that tax rates go up. But once again, we keep having to remind people that, like, when you're working, making a decent living and ordinary income rates, that's the least control you have over your tax situation. When you get to retirement and you can start doing all the things we're talking about today, and you have long-term capital gains, some Roth money, like you can really control what your tax bracket should be, and therefore it should stay lower. Roth conversions. So converting during low income years. Another way of looking at Roth conversions is if the market dips in the middle of the year, and you're wanting to do a conversion at some point. Let's say you're willing to convert 100,000 and the portfolio drops and you convert 100,000 then, that's better than converting 100,000 before it went down. Now, if you can tell exactly when the market's going to go down, we've got a job for you at Capita. But
that came up recently though, because there was a recent dip in the stock market and it rebounded and there's all kinds of stuff happening there. But on that dip, some comments came through of like, this is the perfect time to do a Roth conversion because there was this drop.
Better than a couple months ago.
So,
exactly. Yeah. I don't have a good answer for how to do that the best way, just because short-term guessing of the stock market and other investments is pretty tough.
But those are some of our most popular videos. If we've got a lot on this conversation, and we have the spreadsheet that people can download for free in the description, and you can plug in numbers around taxability around Social Security, but then also that tax torpedo or tornado or whatever we want to call that, and then how to do a Roth conversion. There's a lot on there because it's such a big topic for people to deal with.
Totally. Next one is one of your favorites, the HSA.
I love the HSA. And there's a whole video that I have. We'll put it right here. I guess it'll be right.
I like that you can do that.
Yeah. The HSA is great. I'll let you explain it though, but that whole video goes through like there's strategies around how to maximize those HSA dollars.
Yeah, I think they should watch your video more than us going deep, but triple tax benefits, tax-free on the way in, tax-free growth, tax-free on the way out. That's the only account that has tax code like that is that friendly. Use it if you can. Have to be on a certain plan, high deductible, qualifying HSA plan. But if you can do that,
and the thing that people fail to understand is you can invest your HSA dollars.
They always leave them in cash.
And so don't leave it in cash. If you have the freedom and flexibility and you don't have high costs, invest that and it can grow over time. And a strategy that we had talked about, and just real quickly, is that if you can pay for medical expenses now with cash, let that invested balance grow over time, and then you can reimburse yourself later.
Yeah, I have a process for this, and sometimes people are like, hold on, what did you just say, Eric? That seems complicated. It's not. It's not complicated at all. Anytime I pay for anything, for like a doctor visit or something like that, there's always an option to like print to PDF on your computer or take a picture of it with your phone, hook up Google Drive to your phone, the app, and I have a Google Drive. And once again, like disclaimer here, I think Google's pretty safe, but all I'm putting in there is medical receipts on that. So I don't think it's a huge risk, but use computers at your own risk. But the point is, I have a Google Drive folder, and inside it is medical receipts, and then there's a subfolder for already reimbursed. And then inside the medical receipts, not the subfolder, but the medical receipts folder, I have every medical receipt that has not been reimbursed. And so I take a picture of it and go to that app, drop it in there. I name it with the dollar amount first, the person it was for. So let's say it was a $200 doctor visit for me. So it would be $200, Zacc, date. And then I can look at that list in that folder if I ever want in the future to get $10,000 out of that HSA. I can just grab all of those receipts, put them together, and that's my $10,000 reimbursement from years ago, and then I'll just grab them all and drop them into the reimbursed folder, and you're good to go.
If you paid for those medical expenses with just your regular dollars,
Yes,
not with your
not
HSA.
the HSA.
Yep.
Yeah, you can't do it twice. You can't pay with the HSA and then take it out of the HSA on top of that.
Yeah.
Yeah, so I try to pay for all of my medical expenses with my regular cash flow, hoping that I can leave the HSA alone as long as possible. And then it's pretty rare that we would actually take money out of the HSA. I'm just hoping that thing grows all the way till retirement.
There are some things with HSAs and Medicare that come into play. So again, we've got videos on that, but HSAs are fantastic. I think we both agree that we love them if you are able to use them in your underqualified plans.
So the more advanced strategy, number 3 in this category, so we did Roth Conversions, HSAs. The third one is Marginal Tax Bracket Management for a retiree. So your ability, we've talked a lot about this, so I'm not going to go over it too much again, but having the different levers to be able to pull different amounts from taxable sources, like tax deferred sources like IRAs that are traditional or 401k traditional, versus after-tax brokerage portfolios that could get long-term capital gain rates or other things, and then Roth and HSA, which are at zero. Just having the control over those things, or maybe even rental income, Social Security income, that kind of control allows you to do a lot of really creative things to get your tax bracket just where you want it. But you have to be aware of those lines, and that's part of that annual planning process.
And that's such a huge thing that a lot of people have realized this. It is the most downloaded thing on our website is that Social Security taxability worksheet. But starting for those who are eligible and taking Social Security benefits, like that is your foundation. And then you have so much control over all of this other stuff that you're needing. If you need this much money to live on in that year and a certain amount starts with Social Security, you've got a lot more flexibility if you have those accounts in the right places.
Right. And there are a lot of really wonderful financial advisors out there in the world, but I think less than a third of them, this is my guess, so this is not a stat. Compliance loves it when I make stuff up like this. But my guess is that less than a third of them out there know or really understand that, and I think that's generous, really understand that Social Security taxability or taxable portion of Social Security issue. Yeah. And then state-specific strategies. So each state has its own rules, so it's hard to cover 50 of them in an episode like this. Not that I would even know. Do a road trip? No. I love that you loved that. I wouldn't. I'm just going to explain a little bit about Utah. In Utah, the line is important. We've talked about the line. That's the jumping off point. That is the first spot on the Utah tax return. So they don't care about anything, total income and adjustments and all of that. They just say, let's start with line 11 on the federal tax return. We'll make that our line 1, and then we'll start doing our own calculation from that point, which is super helpful to know because anything you do above the line impacts and helps your Utah state tax income calculation as well. So that's probably the biggest state-specific thing that I think people should talk about. But there are also little things like if you contribute to a 529 plan, you get a little bit of a credit, or there are going to be little state-specific things you can do. I mentioned earlier, our state does allow self-employed individuals to pay their state income tax from the business. That's another one. That's a big one.
Utah also taxes Social Security.
It does, yes.
So there's
you listed them out here.
Seven.
That's sad. I didn't realize that we were among the 7 that do.
Yes, 7 states tax Social Security. Utah is one of them.
Good times.
And they all have their own rules on that too. So the states that do tax Social Security are not the same procedure to get to what that amount would be.
Yeah, so the state tax stuff is more difficult to talk about in a situation like this. I guess the point is just pay attention to what is happening within your state tax return. Very few people actually go over to their state tax return and look at it with much detail.
Yeah. I think we brought this up at the very beginning of this episode of the fact that all of these things that you've talked about, again, if you're coming up on your April 15th deadline, like that is the wrong time to try to figure all of these out. And
you can't do any Roth conversions. You can't do any trading in the portfolio. You can't control which funds are producing income and what types of income. Like if every year you're looking at it in April, you're just setting yourself up for disappointment. You're like, oh, I should have been looking at that last year. It's like, well, last year is this year for next year. You know what I mean? Like it's time now to focus on how you're going to feel in April of 2026.
And there are a lot of great CPAs out there and people who do the taxes for you, TurboTax, all of that stuff. They are not strategizing around this for
Not
you.
normally.
There are some that do, but TurboTax doesn't. Like TurboTax isn't going to like, hey, heads up. But an actual CPA that's helping you file your taxes, it seems like in my experience, a lot of them are just taking what you've done and like, all right, let's work it back from there and find what we need to.
Accounting for the past.
Yeah, but it's not projecting for the future.
Agreed. This is a state-specific thing. I know our labor market within the financial services industry a little better than I know other states. There is a shortage of CPAs right now. They have 10% fewer college students in accounting programs each year, and fewer and fewer of them. So they are pushing up their prices because that's how supply and demand works, and they are spending less time because they are swamped. So less time per person, more time overall. I think they're working like crazy and trying their very best, but they're trying to figure out how to manage their life. And so they're spending less time. So in other words, they're even more, I think they're being pushed more and more towards backwards looking accounting than forward looking strategy, unless you are paying big dollars specifically for forward looking strategy. So a lot of people are disappointed in their CPAs for not looking forward and doing strategy. And a lot of CPAs are like, well, you didn't pay me to do that. You paid me to file the past. There's a little bit of a disconnect in what people are expecting versus what the accountant is expecting to do themselves. So either you have a conversation with the accountant to say, I need strategy. How much does that cost? What am I actually paying you to do? What are part of the services, and how do we look forward more? Or you get good at looking forward a little bit better, or you find financial advisors who do it. There's great software out there, more and more software available to financial advisors than ever before to analyze tax returns. We have our own. We drop your tax return in it, and we can model out scenarios, audit, give you a bunch of recommendations, show you the phase outs of all the magis that we talked about earlier. That's the type of thing that I think financial advisors are being asked to do more, which I think is great. I'm happy to. I actually prefer that. So I think it's on the financial advisor to basically cover the six of the, how they say it, of the accountant. So when it comes to tax strategy, I like working with our clients from April to the end. Well, it's for the whole year, but today is May 1. And today till the end of the year is when you're going to make the greatest impact on what you will pay next year for 2025. And I think the financial advisor should be involved in that and really be looking forward to help cover and help the CPA and collaborate with them. So some of the things that you can do throughout the year that are hard to do at the end or beginning. So because markets are variable, I'm thinking about COVID, the year of COVID, 2020. Markets dropped drastically in February, March, and into April. If you wanted to do tax loss harvesting, then that would have been the time to do it. But a lot of people will wait until November and December. And by then, the markets had come back quite a bit, and the opportunity wasn't as good. Personally, during that time, I will take a step back and just say, like, we looked at that and felt like a strong rebalance into lower asset classes that had dropped more, was more advantageous than the tax benefit of tax loss harvesting at that time, because we were able to buy stocks at a lower price. And those, because of something called a wash sale rule, become difficult to do. You can kind of do them at the same time, but it's harder when you own individual stocks especially. So we decided to lean heavy into buying cheap investments instead of tax loss harvesting. But the point is, if you wanted to tax loss harvest, that would have been the time to do it, not November and December. Roth conversions. If the markets go up, which on average most years are up, your Roth conversions done at the very beginning of the year will be worth more than if you did the same amount of conversion at the end of the year. The IRS doesn't care between January 1 and December 31st, whether you converted 100,000 at the end or 100,000 at the beginning. And you can't make an argument to them, well, it was 100 in January, it's now 110. Can I just do it in December and call it 100? No, it's 100. So if you can do it at the beginning of the year and it grows, that's going to be better for you. The hard part about that is you actually, for a lot of people, they don't know their tax situation that well until the end of the year. And then we talked about the idea of being able to convert after a market decline. So those are the three different conversion scenarios. A lot of people will wait till later in the year, or they'll say, I know I'm going to convert a decent amount. I don't know the exact amount. I'm going to convert 50 today in January, and then we're going to wait. And throughout the year, if the market drops, I'll just convert the other 50, or I'll wait until October, November, and I'll do it then when I have a better picture on my tax situation and convert. Maybe it's 40 or 60, depending on the rest of their income.
Does timing come into play from charitable distribution type of a thing?
Charitable, not as much, other than, of course, the timing of the investments. Like if you've had a really great pop on an investment and that was one you were thinking about giving anyway, then yeah, that would be a good time to consider taking advantage of that gain. Because once you get rid of it, like you get the tax benefit of it, and whether the charity holds it or not, like let's say they hold it and it drops another 30% or something, that's irrelevant. You don't even know that happened. You don't know that they held it. It's theirs. So the timing of investment, but again, those are things that are impossible to completely predict. But I've found that Q4 is a good time for charitable planning, just because. So December's bad because the brokerage firms get overwhelmed and they get to the point where they're like, if you send anything to us in December, it's best efforts basis. So I like September, October for strategy, November for implementation. At the end of that time frame of October and November are good for like people who have a hard time knowing exactly how much money they make. I'm in that boat. Like I never know exactly how much money we have to spend as a business, how much money we're going to make. Like it's a guess, and then we check the guess after the year's over.
Yeah.
So end of year, I have a better guess than January, February. So then at that point, it's easier to know what kind of contribution or like transfer I want to put into the donor advised fund to try to control my tax bracket.
You know, as you talk through all these strategies, I think that, and maybe those watching can empathize here of there's a lot. And at the same time, as you're talking through some of them, I'm like, oh yeah, I think I could leverage that. And others where I'm like, I personally wouldn't be able to leverage that one. So there's several strategies working throughout here. And as people go through this, to your point, I hope they don't look at this if like Zacc told me to do this, so now I'm going to go implement this.
Exactly. Oh my goodness. There's so many things we've talked about in here that do not apply to you. That's something you should be aware of.
Yeah. So if you have an advisor, great, use them. If you do it all yourself, hopefully this helps kind of give a bigger picture view of opportunities that you have. If they don't fall into that camp, they don't have an advisor that they are enjoying, or they aren't the DIY person and they do want some help, this is kind of the opportunity after they've listened for however long we've been going, where you can tell them a little bit more about yourself.
Yeah, congratulations to making it this far on a tax conversation. Good job. Capita is willing to help. Like, we want to help everyone. Especially, we're happy to talk to anybody about their tax situation, give them ideas, dive deeper on any of these categories. We are an investment advisory practice that helps mostly folks thinking about and planning for and in retirement, like, 30, 40, 50s to 70s, those who are looking for a relationship with a financial planner long-term. And anybody who's even remotely interested in considering that type of relationship, we'd be glad. I mean, we have to pay money every time we audit a tax return to this software, but we'll pay that for you. Like, we'll do that for you if you're like remotely interested in a long-term relationship with us. We'd love that. We'd love to help. And if you're more just curious about us, call us. We'll ask a couple questions. We'll understand your situation a little bit. We'll give you conceptual ideas around all these things. But again, we're happy to take your tax return and audit it, give you back a report, run some scenarios, go through these strategies and tell you which ones we think would apply best to you and how you would execute on them. It'd be totally fine. And that doesn't come with an obligation to do business. The only ask is that you just maybe be open to the idea of like, is Capita the right like financial partner for you long term? You don't have to be decided on that. You just have to be open to the possibility of it.
Well, you are always generous with your time. Our videos always go really long because I have so many questions, and you do a good job of answering in depth for people. So thank you for making it this far. For anyone who watched, your music medium is the tequila code, is a repeat.
I want to know. We're going to know a lot about your age based on what you say.
Zacc, you're awesome.
Okay, thanks, Eric.